Most people believe that investing is like piloting a complex jet. They think you need 8 monitors and a doctorate in finance to succeed. They imagine that wealth is built by staring at charts and making split-second decisions. But the brutal truth is that complexity is a product sold by Wall Street. They want you to feel confused, so you will pay them high fees for their advice. Today, we are going to destroy that myth once and for all. The most successful investors in the world use a strategy that is actually quite boring. They call it the lazy portfolio. It is a system that allows you to own almost every major company on Earth. And you can set it up in less time than it takes to brew a pot of coffee. If you are tired of the stress and the constant noise of the news, you are in the right place. We are going to look at why simple is better and how you can automate your future. Think of your investments like a crock pot rather than a frying pan. A frying pan requires constant attention and can burn your dinner in a heartbeat. But a crock pot works best when you set it and leave it alone for a long time. That is the secret to building lasting wealth without losing your peace of mind. Wall Street loves to talk about beating the market. They promise that their experts can pick the next winning stock before anyone else. However, historical data shows that over 90% of professional fund managers failed to beat the simple market index over 15 years. If the professionals with all their supercomputers cannot do it, why should you try to compete with them? The lazy portfolio is built on the idea that you should stop trying to beat the market and simply become the market. Let us look at the engine of this strategy, which we call the 3-fund portfolio. The first part of your engine is the total stock market index fund. Instead of trying to find one lucky needle in a haystack, you simply buy the whole haystack. When you buy a fund like VTI from Vanguard, you own nearly 4,000 companies. You own the giants like Apple and Microsoft, but you also own the small companies of tomorrow. By owning everything, you guarantee that you will never miss out on the next big winner. You do not have to worry if one company goes bankrupt, because you have thousands of others supporting you. This is the ultimate form of diversification within the United States economy. The second part of your engine is the International Stock Market Index Fund. America is a powerful economy, but it only represents one part of the global market. By owning a fund like VXUS, you have a stake in companies across Europe and Asia. This protects your wealth if the United States dollar or the domestic economy faces a downturn. It provides a level of diversification that most individual stock pickers can never achieve. There are decades where international stocks outperform American stocks. By holding both, you ensure that your portfolio is always participating in global growth. The third and final part of your engine is the Total Bond Market Index Fund. This is your safety net, or your financial cushion. Bonds act as a stabilizer when the stock market gets volatile or enters a crash. A fund like BND helps you sleep better at night because it does not swing as wildly as stocks. Bonds provide a steady stream of income and preserve your capital when times are tough. If you prefer using Fidelity instead of Vanguard, the strategy remains exactly the same. You can look for funds like FSKAX for the total American market. FTIHX handles the international side of your portfolio, and FXNAX is the Fidelity version of the total bond market. The fees on these funds are so low, they're almost 0%. This is critical because fees are the silent killers of your retirement dreams. A 1% fee might sound small when you first hear it, but over 30 years, that 1% can steal 1/3 of your total nest egg. Imagine working for decades, only to give away 30 years of growth to a fund manager. By using the low-cost index funds we discussed, you keep the money for yourself. You are no longer paying for a broker's expensive car or a fancy office building. Now, you might be wondering how much of each fund you should actually own. The answer depends on your stage in life and your tolerance for risk. This is what we call asset allocation. If you are in your 30s or 40s, you still have a long time to grow your wealth. In this stage, you might choose to be more aggressive with your allocation. A common split is 80% in stocks and 20% in bonds. This allows you to capture the high growth of the stock market over the long run. But if you are over 50 or approaching 60, your goals start to shift. At this point, you want to protect what you have already worked so hard to build. A classic 60-40 split is often considered the gold standard for safety. That means 60% in total stocks and 40% in steady bonds. The key is to choose a balance that prevents you from panicking during a market drop. If seeing your account balance go down makes you want to sell everything, you need more bonds. Investing is 90% psychology and only 10% math. The biggest enemy of your wealth is not a market crash. It is your own emotions. The news media makes money by keeping you in a state of constant fear. They want you to believe that every dip in the market is a reason to run for the hills. But the most successful investors are those who can stay calm while everyone else is panicking. The lazy portfolio works because it removes the need for human judgment entirely. We use a powerful technique called dollar cost averaging to build your position. This means you invest a set amount of money every single month, no matter what. When the market is high and expensive, your monthly contribution buys fewer shares. When the market is low and people are scared, your money buys a lot more shares. Think of it like a sale at your favorite grocery store. When prices go down, you should be happy because your money goes further. In the long run, you end up with an average cost that is very favorable. You are essentially buying the world on a discount whenever the market goes down. Think about the massive peace of mind this approach brings to your daily life. You do not have to check the stock ticker during your lunch break or before bed. You do not have to worry about whether a specific CEO is doing a good job. You own the entire economy, and history shows that the economy grows over time. This strategy also protects you from the danger of following the latest trends. Many people lost their life savings chasing individual tech stocks or unproven assets. By sticking to the three-fund portfolio, you avoid the traps of greed and speculation. To get started, you simply need to choose a reliable, low-cost broker. Fidelity and Vanguard are two of the best options for residents in North America. Once you open your account, you can set up an automatic transfer from your bank. This makes the act of saving and investing completely invisible to your daily spending. If the money never sits in your checking account, you will never be tempted to spend it. After your account is funded, you select your three funds and set up an auto buy. At this point, your job as an investor is almost entirely finished. The only thing you need to do is check your account once a year for rebalancing. Rebalancing simply means selling a little bit of what went up and buying what stayed flat. For example, if stocks had a great year, they might now represent 70% of your account. You would sell that extra 10% and buy more bonds to return to your 60-40 target. This forces you to sell high and buy low without needing to predict the future. This keeps your risk level exactly where you want it to be as you age. Wealth is not just about a large number in a digital bank account. True wealth is the ability to own your time and live your life on your own terms. It is about being able to help your children or spend a Tuesday afternoon in the garden. It is about the freedom to travel without worrying if you can afford the flight. When you simplify your investing, you reclaim your mental energy for what matters. You no longer have to waste your weekends reading financial news or worrying about interest rates. You can focus on your health, your family, and your passions. Eventually, you will enter the withdrawal phase, where you live off your investments. Many experts suggest a 4% withdrawal rate as a safe way to fund your lifestyle. This means you can withdraw 4% of your portfolio each year and likely never run out of money. The lazy portfolio is designed to sustain this withdrawal rate for decades. Imagine what you would do if you never had to worry about money again. Think about the person you would spend more time with if you were not working so hard. Write down your dream retirement day in the comments section below. Describe what you would see, where you would be, and who would be by your side. Focus on that vision every time the world tries to make investing feel complicated. The lazy portfolio is your bridge from where you are now to that dream life. It is the path of least resistance and the path of greatest long-term success. You do not need to be a genius to be a successful investor. You just need to be disciplined enough to keep things simple. Stick to the plan, ignore the noise, and let time do the heavy lifting for you. Your future self is waiting for you to make this one simple decision today. Thank you for trusting me with your financial journey and for valuing your peace of mind.